Well, hello. Let's go ahead and kick off. I believe most everybody's coming is in the room today. Glad you guys could make it, and thank you for spending your afternoon with us. We're going to spend the next hour talking about the first module in a 4-week series called How to Raise Funding from Angel Investors. My name is Hall T. Martin. I'm the director of the Texas Entrepreneur Network, and my background is I've helped start 3 angel networks and currently run an open funding forum network that goes throughout the state of Texas. And what we're going to do today is we're going to go through 4 modules. Each module takes about 10-12 minutes to go through, and then we'll leave some time at the end of each module to have you guys ask questions. There's a question box in the lower right-hand corner of your screen. Feel free to just type in questions whenever they come to you, and after we go through a set of slides, we'll stop and we'll read out the questions and answer them and dialogue a little bit about them if we need to. Of course, afterwards, if you have questions that don't quite fit into the format of the webinar we have today, by all means drop me an email and we'll set up a time to talk by phone or email either later today or next week. So always available to answer any questions you have if they don't fit inside the webinar format. Just let me know. Also, we'll be taking a copy of these slides and emailing them to you tonight, and we'll be posting the webinar on the website in the next day or so you can go back and re-watch or re-listen to the webinar if you like. It takes us a day or two to get it up on the web, and they are quite large files, so they're difficult to email directly, but we'll make that available to you guys also. So with that, let's go ahead and kick off. We've got here today how to raise funding from angel investors. And in this session, the first one of 4 that we're going to do today, there's 4 today. Actually, there's 4 each week for 4 weeks, so there's 16 modules that we'll go to. And what we're going to talk about here in a moment is what are angel investors and why do you want them? And then we're going to talk about a timeline for raising funding. And so with that, let's go ahead and kick into it. Angel investors are basically high net worth individuals seeking to make a return from their investment. Now, oftentimes these guys are providing donations to various organizations, but when they have their angel investing hat on, they're fundamentally looking to make a return, not a donation. Also, they meet the accredited investor requirement. Angel investors have to meet a requirement set by the Securities and Exchange Commission, SEC, to be able to invest in startup deals such as yours. And fundamentally what an accredited investor is someone who has $1 million of net worth, not counting their primary residence. There are other definitions for how to become an accredited investor, but the vast majority are simply have the net worth that gets them there. Also, as I said before, angel investors are seeking to make a return on their investment. They're not making a donation, but they do want to do some good. In fact, someone once said an angel investor is someone who wants to make a little money, do a little good, and have a little fun. And I find that to be very true with many of the angel investors I know and I work with as well. Now, also, they are not typically professional investors. They are people who are successful in other ways, and they often have substantial business experience. But unlike venture capitalists or private equity investors, it is not their full-time day job, and they do not make a profession out of it. And so you'll find angel investors of a wide variety of skills and expertise and interests out there. Some know a great deal about it, some know very little about it. And so don't be surprised if you find an angel investor who seems to be inexperienced, because most angel investors, when they first come in, are learning on the job, so to speak. And what you also find is that each angel has their own criteria for what they invest in and how they invest. For every kind of deal, there is an angel investor out there. They are a wide variety of people with a variety of backgrounds, and you won't find that they're all cut from the same cloth. They are very different in what they do. Now, why do you want angel investors? Well, angels bring expertise. They also bring a network of experienced people. And as you build up your startup and as you launch your company, you'll find that oftentimes you'll need access to other experienced people, and you'll need access to skills that you don't have in your group. And good angel investors can often put you in touch with people who do. And angels also have a standing in the community. If you get the right angel investor attached to your deal, they can bring additional credibility to your project because they're a part of what you're doing, and that can help you in raising funding from other people and from gaining customers and from just gaining a good standing in the community for your company as well. And what we recommend you do is that you can invite angels to join your board of advisors. And I define a board of advisors as someone who is helping your company, but you're not compensating them directly for that. Now, you're not asking them to do a lot of heavy lifting, but at the same time, you're attaching them into your project or your company in a certain way. Also, you'll find angel investors typically know other angel investors. And so as you go to raise more funding, your current investors can help you find new investors to come into it. So what is your timeline? And this is a question I often get. People often come to me with the expectation that they're going to finish their fundraise by the end of this month or maybe the end of next month at the latest. But the reality is it will take you 1 year for every $1 million you're trying to raise. And so the expectation is usually unrealistic for what people want to do. So let's say you are raising $1 million and that's what you need. How will you spend that 1 year raising your money? Well, the first thing is you need to check the readiness. Are you ready to go raise money? You need to assess your company. Is your company ready to go do it? You need to communicate with your team and investors. I've often been in follow-up meetings with companies who want to raise money only to find out that their previous investors were not aware that they were going out to raise funding, and they were still coming up to speed on this idea. So before you go raise money, you need to make sure that everybody on your team and in your investors are up to speed and in agreement with raising money. Also, you need to check with your attorney. Make sure your attorney's on board with you and make sure you're ready to go. In month 2, what you'll find is you need to prepare the company for raising funding. For example, you'll need certain key documents in which to do the fundraise process. Number 1, you'll need an executive summary. You'll need the one-page version of your deal. You'll also need a slide deck, 12 to 15 slides about your company, showing the pitch, showing people how you're going to raise the money, what you're going to do with it, what your company is all about. And finally, you also need to have a set of financial statements. If you have historical, you'll need those, and certainly you'll need projected financial statements of what you expect the deal to do. And also, it's a good idea to go ahead and put due diligence documents together. Any interested investor is going to want to look at your legal entity, your intellectual property, your tax returns, any filings you made, have you made your payroll taxes, all of these things I want to look at. And my recommendation is to go ahead and put those documents together now. It seems oftentimes when we get into the follow-up or due diligence process with a company as an investor, it takes the companies anywhere from 20, 30 to 40 days to pull those documents together. They don't all seem to be in one place. They seem to be spread around. So we'll need these documents. One thing you'll notice that is not in that list is the 50-page business plan. And over the years, I've seen the 50-page business plan slowly go out of use. Some people still ask for it. Some people still use it. But for the most part, investors are looking at the summary, the slide deck, the financial, and the due diligence documents, and combining those together. That's pretty much what a business plan is all about. So in month 2, you need to get your documents ready to go. Also, at this stage, you need to do an assessment of your team. If you feel your team is weak, it's not complete or balanced enough, you need to go start recruiting additional people to come and join your team. And as we said before, we want them to join as a board of advisors, people that you can help fill the gaps on your team with other people that are attached to the company. So in month 3 to 5, and this is where it may start to veer differently from what you've done before, most people at this point are off pitching investors. We're ready to go hit the street and tell the investors our story. But what I recommend you do in months 3 to 5 is not yet tell your story fully, but first identify potential investors for your prospect list. These are investors that you know, people that you can get referrals to, people you don't know well or directly, but you can get in touch with them. And then what you want to do is set a goal that you're going to add 10 new investor prospects to your list each month. So month 3, month 4, month 5, you're putting 10, 15 investors on the list every month. And then you want to set up meetings with investors to introduce the deal. You go out to the coffee shop or you get on the phone, and what you do is you say, I want to keep you informed of our progress. I'm not yet ready to raise money, but in 3 months I will be. May I put you on the list and keep you informed of how we're doing? And you tell them a little bit about what you're doing so they get interested, but you don't give them the pitch just yet. Oftentimes you're still building up the business, you're still pulling things together, and what you're trying to do is get permission to put them on the list and to start educating them on your deal. And what you do after that is you send them short 2-3 paragraph emails every month about your deal. And you want to make sure those emails are personalized to the investor. They're not a broadcast email. You don't say, "Dear investor," and then just send the same thing to everybody. It has to say, "Dear Jim," or "Dear Mary," or "Dear Joe." And it has to appear to be a one-to-one communication. With email systems today, that's not hard to do, but even how easy it is to do, most entrepreneurs don't do that. In fact, most entrepreneurs don't even send email communications to their investors aside from their putting the investors on their PR database. I often get PR broadcast letters from startups seeking funding, and it really doesn't bode well. The investor is a different group from the media. They're different from customers, and so you don't want to treat them as the media or as a customer. You have to treat them as who they are, which is an investor. An investor has a certain set of care-abouts. They're caring about the shape of the business model, the sales channel, all the elements that is going to grow and make the business, not just the product, not just the newsy announcements. And so you have to create a special communication for the investor, and you have to show that it's a personalized message at some level for each investor that's on your list. So you want to start sending those out every month. And the reason we want to do this is we want to educate the investors. The ones who raise money are the ones that get the investor up the curve on their deal. And they say it takes 7 touches to close a sale. Well, so it also takes 7 touches to close an investor. And what we're doing is we're actually starting that touch process well in advance of the pitch process. We're starting to educate them on our deal, on our market, on our segment, on our team, etc. And what you want to do in this letter is also demonstrate that you achieve milestones. Almost every angel investor I know, when he sees a deal, he asks, "What are your plans for the next 3 to 6 months?" And whatever the entrepreneur says, well, the investor writes that down. In 3 months, they're going to be doing X. And in 3 months, some of them actually go back and check to see, did you actually do X in 3 months? And they're trying to figure out, do you achieve milestones? And so what you do here in this process is that you do that for them. You demonstrate to them what your plan is, and then you go demonstrate through these email communications that you are achieving milestones. When you get to month 6, well, now you go back to those same investors you've been emailing and communicating, and they've been introduced to your deal at some level, and you follow up with each one and you say, "We're now ready to raise money." And you then go out to the coffee shop or on the phone or in some way, you start to pitch each investor. And in this process, you start to identify what we call the lead investor. And and that will become important here fairly soon. But in the next 3 months, months 6, 7, 8, 9, you're trying to find the lead investor and close them in this process. And of course, you want a lead investor that's going to come up with investor-friendly terms that will encourage others to come into it. But the reason you want to start looking for a lead investor is that it's often the case that entrepreneurs have 3 or 4 investors interested in their deal, but none of them want to go first. They don't want the risk, they don't want to spend the time, and they don't want to be the first one in the deal, because the risk is that the first one in the deal can be the only investor in the deal, and that's a difficult spot for many investors to do. And so what you have to do is start looking for an investor who will write a little bit bigger check, but at the same time you offer an incentive to the lead investor for the risk they take. You can offer extra stock options, extra warrants, extra discounts. You can do things that will make it worth the time for someone to be the lead investor. And what you do is you gather up all your due diligence documentation and put it into one package, have the lead investor review it, sign off on it, and then as other investors come in, you've got the documentation already set that you can provide them, and then with a lead investor in, you can then close others to come into it as well. So after month 6, 7, 8, or 9, hopefully by then you've got a lead investor. If you're adding 10 new investors every month, since you started the process, by now you should have 40, 50, 60 investors on the list receiving communications. After the 7 touches, or about 6 months, 10% of those investors will come back to you expressing interest in your deal. And one of them potentially could become a lead investor. Once you have the lead investor signed up, you can then go and close the remaining investors. You start inviting other investors to join the round, and you start the document signing process. It will take you a month or two just to sign the documents. The lawyers have to draw up the documentation. The investors have to wire the funds in, find the time to sign the docs, read the docs, close out the process itself. And then in month 12, hopefully you've done this, you now move into a place where you've closed the first round and you're ready to go on to the next step. Now, most entrepreneurs at the end of the process drop all communication with investor prospects. They keep the investor communication with those who invested, but those who did not invest, they drop that immediately. But what I recommend you do is continue sending updates, maybe not monthly, but rather quarterly, about your progress to your prospect list and what you can share with them about it in order to prepare them for the next round of funding. Most entrepreneurs say they're not going to get a next round of funding, but it's often the case that they come back 12, 18, 24 months later and say, oh, but I do need additional money. And if you take these investors that you've kept informed, you can maintain the relationship and carry them to the next stage and potentially get funding from them in a later stage. It's often the case investors are interested in your deal, but they are very risk averse. They don't want to be in on the first round. But in a second or third round, you'll find that many people will come back up and be a part of that because it fits their risk profile a lot better. So at this point, let's stop and let's take some questions. There's a question box in the lower right-hand corner there. If you could, go ahead and just type in any questions you may have, and we'll answer those. So the first question is, how do I know if an investor is a good lead investor? And the answer to that question is, number one, a good lead investor is someone that is going to write a little bit bigger check than what everyone else is going to write. In other words, you're not looking for a $25K check writer to lead your deal. You're looking for somebody that's going to invest $100, $125, $150,000 in your deal, and because of that, they're going to be a better investor. Number two, you're looking for somebody that may have some experience in doing angel investing before, and so it adds credibility to your deal because other investors will see them as being credible and will take their due diligence and their assessment as a positive for your deal itself. So you're looking for someone that's going to be writing a little bit bigger check, has a little bit of a reputation, and it'll be pretty clear when you see the guy that he may be a good one to lead your deal as well. The second question comes up is, what about attorneys? What role do they play up front? Well, quite often the answer to that question is when you go out to raise funding, you need to make sure you have the right legal entity and you have the right documentation to go in front of investors. For example, most investors want you to be a C corporation. You don't have to be a Delaware C. If you're raising funding in Texas, a Texas C corporation is usually sufficient for what you want to do. If you're raising funding outside of Texas, either on the West Coast or East Coast, you'll probably need a Delaware C in that case, or that would be better. If you come in with an LLC, there are many investors that are not excited about LLCs and they won't like that entity for what you're doing. Also, if you're signing up investors, you need to make sure that they are accredited investors. So as you seek to take funding from family and friends, you'll often find that they are not accredited investors, and that could be a problem for your deal down the road as well. What other questions do we have? Let's see. So how do you know when you have enough investors to start the closing process? Well, the answer is as soon as you have investors interested, you start to go through the closing process. Even if they haven't written checks, you start to signal that we're going to be finishing the round soon, we're ready to move forward, and you try to create a sense of urgency or a sense of closure on this. Again, having the first check in goes a long ways toward that. And in your monthly communications, you need to be putting out not only how you're doing in the product development or how you're doing with sales or building the team or anything else related to the market, but also how you're doing with investors. If you've got investors interested, if people are signing checks, if you're reaching your goal, well, then you should also communicate that to the investors to make clear that there's other people in the deal, other people leading it as well. I think that's all the questions we have for now, but if anything comes up, just go and pop those in and we'll answer them as we go forward. Let's move on to the next module called Assessing Your Readiness to Raise Funding. So the question I always get is, are we ready to raise funding? And most entrepreneurs ask the question, do I need funding? But many don't ask the question, am I ready to raise funding? And so as we said before, you need to make sure that you have a legal entity. I see often companies that don't even have an LLC often looking to raise funding. And it has to be a C Corp, as we just answered in the last question there a moment ago. Next question is look at is product or service. Do you have a product in the marketplace? Investors today really don't invest in seed stage concepts anymore. They want to see something developed or under development that they can look at and evaluate, and they want to know that you're bringing something to the table and not just a PowerPoint slide with a great concept. If you don't have a product actually in the market under sale, the question I always ask is, will you have one in the market in 3 months or less? If you're going to go to market in 3 months or less, you're still in the range for engaging investors, because typically in the 3-month window you've got beta customers, you've got people looking at it, you've got customers evaluating it, and angels want to be able to talk to potential customers and get some feedback on it. What they're looking for is some level of market or product validation that the product will work and they'll be happy with it. And then, do you have any customer interactions with your product? It's even better to actually have a customer testing it out or trying it in some way, so that demonstrates that customers are actually working with it in some fashion. Next is sales. It's always advantageous to have sold a few units. You don't have to sell a lot of them, but you do need to sell 5 or 10 units if you can, again to show that the product works and that the customers will buy at the price you ask. So you have product validation, and then you have market validation. Also, you want to demonstrate the business model, and this is partly what the investors are trying to figure out through having sales, is do you really understand your business model? In other words, can you cite the metrics such as cost of customer acquisition? Can you show what the product development costs are? As you get to a place where you're starting to ship the product, you're starting to understand how much money it took to actually build that product. And you're understanding then what kind of profitability comes out of it. In software deals in particular, what they're looking for is the cost of customer acquisition and the lifetime value of the customer. How much did it take to sign the customer up? And then how long does that customer stay with you, and how much do they pay for the product in order to get the lifetime value? To the extent you can cite those metrics based on limited data, you'll have more credibility with the investors. If you have no idea what it costs to sign up a customer, you have no idea how long they're going to stay with you, you're going to be challenged in raising funding because you haven't really demonstrated the business model just yet. Next is a management team. Now, at the very beginning level or fundamental level, what we're looking for is some level of completeness. And in the startup company world, a complete management team is someone building it and then someone selling it. So it's no fair game to have 2 people building it and nobody selling it. Somebody's got to be the deal maker, going out trying to close the deal, and someone's got to be building the product, making that product work. So they'll be looking very closely at the team as well. Next is financials. Do you have detailed financial projections developed? Now, in your pitch deck, you may be showing summary financials, but in a due diligence setting, investors are going to sit down and look at the very detail of your financial projections to understand how the money is going to be spent, how it's projected out, and they're going to want to see three things. They want to see an income statement, a cash flow statement, and a sales forecast. And to the extent you've got sales clients or customers coming through the pipeline, they're coming into your window, they're experiencing your product, they're trying your product, they're buying your product. To the extent you can identify that sales funnel, that will give investors confidence that you're gaining traction in the marketplace and they should invest in your deal. And finally, there should be due diligence documents here as well. And you might ask yourself, do you have your due diligence documents put together? They'll want to see things like your legal entity, including the articles of incorporation, any patent filings that are out there. They'll want to see your financial records. And so you might as well go and put those documents together now. Also, you need to go talk with your attorney. If you didn't talk to them before, you need to start talking to them now just to make sure they're up to speed that you're raising funding and you'll need their services at some point along the way. And if you don't have the proper legal entity, they can help you with that. And then they can start to guide you on the fundraise documents that they will put together. In some fundraisers, there's actually many, many documents that go into a fundraise. A subscription agreement, quite often you're putting a stock option agreement together, and you need to start learning something about the terms in the term sheet. That's very important because I've been in negotiations as an investor with entrepreneurs, and then as terms are coming up and we're negotiating it, the entrepreneur is leaning over asking his attorney what those terms mean. And before you go into negotiation, you should be familiar with the basic terms that are in there so you understand what the dynamics of that is. Also, your team and your investors. Make sure you've talked with your team about it. Make sure they're on board with your raising funding. And then talk with your current investors. Make sure they're on board with it as well. As many investors will want to talk with your previous investors and get their perspective on the deal. So at this point, let's stop and let's see what questions you guys have as well. If you're ready, just go ahead and type something into the question box and we'll answer those right now. So the first question has to do with sales. How many sales do you have to have in order to be convincing to an investor? Okay, well the answer to that is you need to have enough sales that you can demonstrate the business model. In other words, if you sold just 1 or 2 units, well that may not be enough. If you sold 5 units or 10 units or 20, then you start to a pattern starts to emerge as to what was the cost of customer acquisition. What was the time it took to close the sale? What were the type of customers that were buying it? So you need to have enough that you can start to see certain patterns emerge about what you're doing as well. The next question is on the management team. When you say complete management team, can it be only 2 people? And the answer is yes, it can be only 2 people. And the reason for that is that companies today outsource more and more of what they do. And so you need to have some core people on the team, but it's often the case that you have 2, maybe 3 people on your management team, and then you have an outside group of contractors, providers, vendors, etc. that are doing things for you, such as sales channel distribution or contract manufacturing. Yes, the core team still needs to manage that, but it's often the case that you'll have 8, 9 different contractor specialists that are helping you with some part of the deal, and it doesn't require to have as many people on the team as it used to. But you do need to have someone dedicated to making sure the product works and someone dedicated to actually selling the product, and that's usually the CEO. Next question is cost of customer acquisition and how you calculate that. Well, basically cost of customer acquisition is your sales spend and your marketing spend for a period of time. Let's say in 3 months you were able to sign up 5 customers. Well, you simply take your sales and marketing costs for those 3 months, add that up, divide by 3, and that's your cost of customer acquisition. As you get more customers and more time behind it, those numbers will refine, but it'll give you a ballpark, even if you only have 3 or 4 customers in a 2 or 3 month period, as to what it took to actually sign up those customers. And of course, as you get more brand awareness and more recognition, you'll be able to sign up more customers with less money. So over time, your cost of customer acquisition will go down, but you need to have some idea of where you are today and where you think you may be able to drive it to over the coming few months. I think that's all the questions we have here. Let's go on to the next set of slides. Again, if you have questions along the way, just type them in and we'll stop and check that box from time to time. So the next step is, in our third module here, is how to write an executive summary. So what is an executive summary? For those who don't know, it's basically a one-page version of your business. Everything you're talking about goes into one page. It is also non-confidential information. I often have entrepreneurs saying they can't share their exec summary with me until I sign a non-disclosure agreement. And my message is, well, take out the confidential information and send me what is non-confidential and let me look at that first, because I and most investors don't sign non-disclosure agreements, also called NDAs, without really understanding something about the business first. Second, and most importantly, make sure you put your name and contact details on the exec summaries. As I've often told people, about 50% of the exec summaries I get have no one's name or phone number on it. Even if I think it's the greatest deal in the world, there's no way I can get back in touch with them because there's no name or phone number on it. And make sure you put full contact details down, including physical address, email address, phone number, etc., cell phone as well, because you want to give the investor every option and every possibility in order to be able to contact you in whatever way they want to do it. So in the exec summary, let's look at the key elements to include. The first thing I like to start with is the problem the company solves. First of all, it must be a large problem. It must be a very specific problem. So you need to have a very large market, and you need to be fairly concrete about what problem you're actually solving for the customers. To the extent you use numbers, it'll add credibility to your presentation. If you can quote the amount of dollars a customer spends or amount of hours a customer is spending on a problem, or how much that problem is costing them, or how much that is costing the market as a whole, that will give you a lot more credibility. Second is talk about your product or service that you offer. And here you want to focus on your core product or service. Oftentimes entrepreneurs get caught up in the richness of opportunity in their area and talking about all of the ancillary products they could develop, all the add-ons they could put in there, all the extra things they could sell. But the problem with that is that scares the investors. In fact, at this stage, especially when you have a one-pager to put all this information, there won't be much space to describe all of the opportunity. So you want to avoid too many details on how it works and all the other things that can go on. And that also scares the investors when you have too many products, is that it comes across as unfocused. They're afraid you will be diffused trying to sell too many products at once. And also you want to highlight the economic benefits to the customer. Whatever your product or service does for the customer, turn those into numbers as well. This product saves customers 50% of time. This one saves them 30% of the cost. This one improves their ROI by 50%. Whatever those numbers are and whatever the customer is getting out of it, show how that is compelling to your audience. Next is you want to talk about your competitive advantage. Here, I always like to use the table where we list your company and then 3 or 4 competitor companies in a table, and then show across the other side of the table the features upon which you're competitive, and show 4 or 5 key advantages of your solution. And make sure you include the indirect competition as well. Oftentimes, doing nothing is an indirect competitor. They may not choose you nor any solution out there. They just may do nothing. And you have to demonstrate why they're going to buy your solution versus somebody else's. Next is the target market. Now I like to show the target market in 3 different views. The first and the big view is the total available market. anyone who could use your product is in this. And it's a very big market, a very big number, and it demonstrates that you have a large available market. But then a step down from that is what we call the serviceable market. And this is really your target market. This is the group you're really trying to go for with the product that you're building right now. And then there's a step down from that, which I call the beachhead market. And this is your initial customer target. And the value of this is that it shows a real focused go-to-market strategy. And that's what investors want to see. After they know that you've got a large market, the next thing they want to know is where will you get initial traction. And if you've got 5, 10, 15 customers you're already talking to in a certain niche, and that could be a geographical location such as your home city, or that could be a vertical that or a niche market that is ideally suited for your product, you want to show that here's the beachhead market and here's the traction we're making with that beachhead market. Oftentimes people come in and they say the total available market is $50 billion and we only need 1% of that. And the problem with the 1% rule is that it doesn't show initial traction. It doesn't show where you're going to start first, and you need to demonstrate where you're going to start first and that you've already started. You've already moved into the beachhead market and you're making good progress with it. To the extent you can show size and growth rate of each, it improves your credibility because it demonstrates you know your market very well. Next is your business model. And what you want to do is show how you generate revenue. And in many products this is fairly straightforward, especially if you're selling hardware. It costs a certain amount of money and that's what people pay. But in software it can become fairly complicated. It's often the case today that software deals have 4, 5, 6 revenue streams. They're giving the product away for free, but then they sell the leads and then they sell the advertisement and they do other things. And you have to, in some cases, really define how you're making money, especially if it's not obvious. But then also how you're spending the money. What does it cost to actually run this operation? And then the two key metrics, as we said before, is, especially for software, is cost of customer acquisition, then lifetime value of customers, especially if they're paying on a monthly subscription basis for your deal. Show what you plan to get out of that customer, and then what did it cost to sign them up. And if it is very complex, what you can often do is do a case study. Take a sample customer and say, XYZ company bought my product. Here's what I spent to sign them up. Here's what they spent. And here's how the business model worked with one customer. Sometimes with one customer you can get down to it a little bit quicker than trying to explain it in the abstract. Next is your sales model. And what you need to describe here is your sales channel. How are you going to sell this product? Is it on the web? Are you going to hire a direct sales force? Are you going to get indirect sales force such as reps or VARs or OEMs? But you need to describe how you get this out to the market. And next is you need to go and talk about intellectual property. Here what you want to do is discuss your IP strategy, including any patents you may have filed or plan to file, trade secrets, trademarks, copyrights, etc. Especially with patents, what is always often asked is what has been filed and when. It's often the case that patents have been filed, but they've not been issued or granted or awarded or even have any office actions. An office action means the patent office has looked at it and said, yes, this is clear for you to go carry forward as we continue our research into this patent. But to know you have filed a patent and there's a certain date on it, that's what investors want to know. And if you haven't filed patents, well, you need to do that before you start making public disclosures, or you lose the ability to file patents altogether. And then as you make progress with the patent office and you get office actions, they start looking at your deal and giving you feedback, you can then communicate those to the investors as well. Next is your management team. And you typically only show the top management team, the C-level people. You can show other people down there as well, but typically what they're most interested in are who are the C-level people in your group. While there are many things you can say about your management team, the things I always look for is the number of years of experience that that manager has. 15 years in the industry, 20 years in the industry, whatever. And then places and projects they worked on relevant to this project. So if they're in the IT industry, I want to see that they've worked at Dell or Oracle or Sun or Amazon or Apple. I want to see names of companies that they've worked for or with in some way, shape, and form to know that they've got relevant industry experience. And then this is where you might include a board of advisors to fill out the gaps in your team with other people. Then you need to, in the exec summary, also put in summary financials. And because there's not much space on a one-pager, you just show the very high level, such as the revenue, the costs, and the profits. And these are typically 5-year windows. If you have some historical financials, you have a year or two of operations, that's great to include as well. That shows real numbers, and that shows investors that a lot of the hard work is now behind you. You've done the startup, you've done the launch, you're now up and running, and that gives them some confidence that you didn't just start yesterday, you actually started a year ago or 2 years ago, and now you've got a lot of those startup costs behind you, and now you're ready to scale and grow. Also need to show what funds you're looking for and how you're going to use the funds. So you need to show how much you're raising, and just put that straight up there. I'm raising $500,000, and then I always like to see what you plan to do with the money. Oftentimes what people do is they give me a financial accounting of how they're going to spend the money on equipment or consultants or office space. But what's more interesting to me is what results to the business are you going to try to get with it? How many leads are you going to generate? How many sales are you going to close? How many more products are you going to be able to build? These are the things that are even more interesting, and to the extent you can paint that picture, the investors will be interested in hearing that. And finally, you want to show the exit. Show how you plan to exit the company and return the funds to the investor. Now, it's often the case you don't really know who's going to buy you, but what you're trying to demonstrate is that there is a market out there for companies to buy your company. There are companies who have an appetite for your company or your type of company, and that they pay good money for that. That's about as far as you can go. But that's also a key step to show that you're keeping the investor's interest in mind and knowing that they have to get a return out of this, and so that they're going to be looking at this as well. And then to the extent you can show examples of potential acquirers of how they've acquired other companies, that'll be helpful as well. So let's stop at this point and ask if there are any questions and see what you guys think about what we've talked about so far. So the first question is on financial statements. Do you include balance sheets? Yes, I think if you have historical balance sheets, those are helpful. Oftentimes, investors want to know what kind of debt structure you may have. A common question you'll get is how much of the funds raised are going for debt retirement. If it's a substantial amount, then they're probably going to walk away. They don't want to put money in to take out previous investors. They want to know that money going in is going to help grow the business going forward. So for balance sheets, I often hear investors asking for historicals, but going forward, I don't usually see them doing much with projected balance sheets that are there. Let's see. The next question is on the management team. Do the management team, do they have to be full-time employees or can they be part-time? I think the answer to that question is they can be either full-time or part-time. What I think there is important is as you grow and scale the business, you need to demonstrate you know how to find the right people and bring them in and connect them to your project. And it's often the case that a full list of management people for a team are not actually drawing full salaries and working full-time just yet. They're working part-time, and they're going to come on board when the revenue and the workload justifies it. So I would go ahead and paint the bigger vision of a management team sooner rather than later, and actually if somebody asks in the financials, are you paying full salaries, the answer is no, we plan to bring them on at this point in the process. When you achieve certain milestones is when you would do that. Okay, if there are no more questions, let's move on to the last module we have here, and that is building a team. As I talk to angel investors, what I find more and more, especially as they gain more experience in funding, is that they look more and more at the management team compared to everything else. The venture capitalists come to one of my classes once and do a guest speech, and someone in the audience asked him what he looked for in an executive summary, and he said he looked for 3 things. He looked at the management team, he looked at the management team some more, and the third thing is he looked at the management team again. So he put almost all of the importance on the management team and their capabilities. Could they work together? Did they have all the skills? Did they have the right skills? Did they have the right backgrounds? Were they people that execute? And so these are the questions they were always asking. So the management team is going to be a big factor. And as we said before, the investors are looking for some level of completeness. You've got the basics covered in some way or another. And then they're going to be looking at the critical skill factors. There are certain things you have to have in order to make a business successful, and they'll be asking key questions about how people really have skill factors in those areas. Then the other one is, if you see too many people on the list, what you'll find is investors are thinking that there might be unnecessary headcount. If you have 0 revenue and you have 6 or 7 C-level people, that may be too many people for the early stage. So as we said before, the core team is someone building it and someone selling it. As the company grows, the division of labor becomes more sophisticated, and you need a 3rd and 4th person to come in to do different things. But it's often the case that the financial work is outsourced in the early days unless it's a real critical factor to the growth of the company. And it's often the case that manufacturing is outsourced, but yet someone is still watching that from the core team and managing that at some level. You should also identify future hires to bring on when revenues and funding justify it. So you may have a plan for how you're going to staff up additional people when you get to that phase. And like I said before, a full management team slide doesn't mean all are working full-time or even on a paid salary. Also, what investors will look for is people that have recently come from large companies. And it's often the case that people that move out of the corporate world back to the startup world are not quite as helpful as people that are based in the startup world, because the large companies have a very different work environment, they have a very different mindset, and they're not quite as appropriate for startups as people that are just straight from the startup world. And as we said before, startup skills are different than big company skills in many ways. So board of advisors, and these are people who I say you should attach to your company, and they will help out even though they are not compensated. They will not do a lot of heavy lifting. They will not spend a lot of hours on your deal, but you can get a lot of good advice. And my recommendation before you bring on any C-level people or major investors is that you first sign them up on the board of advisors. And a board of advisors is not a board of directors. A board of directors is a group of people that once you have raised funding, a board of directors is assembled to oversee the shareholder and the company's interests in the deal. So the way you put a board of advisors together is make a list of the areas you need help in, and then start recruiting people to fill those areas. And you invite them to come meet with you on a weekly basis for an hour or so, not a lot. You explain what you're doing, how you're doing it, and then you ask their advice. After a month or two of doing this, you'll get a much better sense of who these people are, and they'll get a much better sense of what your company is all about and your team. And at that point, as I said before, if you have potential C-level people or investors you're thinking about bringing on board, after they go through a month or two as a board of advisors, you'll have either a lot more confidence that you want to bring them on or you don't. As we said before, you meet once a week for coffee to discuss, and you get their assistance on your deal, and they're attached to your deal even in an informal way. And C-level recruits and investors, it's also great to recruit them through this mechanism as well. The other thing to look for as part of your team, and most don't consider it that, is your service providers. When you go to recruit service providers, find people who know your startup space very well and the startup space in general. So find those attorneys and accountants and publicists and other people that can help you beyond their core service offering. Yes, the attorney will help you with the legal work, but can they help you find investors? Can they give you guidance on how you might be able to start your company with less money based on what the attorney has seen other companies do that have gone through their channel? So let's stop here and see what questions people have and see if there's anything else we need to cover before we end the session for today. Okay, so the first question is where can I find a good attorney that knows my startup space? Well, afterwards, let's set up a phone call and let's talk more about what startup space you're in and what you're trying to do with your deal, and we can point you in the right direction for companies or attorneys that may know your space very well. We know quite a few attorneys in the area, and we might be able to point one out. The other thing to just make mention of with attorneys is that there's many different kinds of attorneys. Some cater to angel deals, some cater to venture capital deals, and some cater to bootstrap deals. And so you always want to get someone that caters to the right kind of company you are as far as fees and services that they offer. And you can overbuy services pretty quickly out there, so we don't want to do that. Let's see, what other questions do we have here? Let's see. The question has to do with recruiting family members. Is it okay to have a spouse as part of the core team? And I will probably say that's probably a no. A lot of investors have a rule against investing in deals where it's a husband and wife deal or it's a family deal, and that's because the family dynamic is very different from the business dynamic. If things aren't going well and you have to replace someone on the team, if it's a family member, that can be very, very difficult to do. So a lot of investors shy away from that scenario altogether. If they've ever gone through that, and I have myself, it's just can be very tough. So the answer is family members on the core team together are probably not a good idea at this stage. Let's see. The next question up is how do you know if somebody from a large company who wants to work in a small company is a good fit? And I think the answer to that is well, you don't until they prove themselves, and so you might want to put them on your board of advisors for a month and see how they do with some small projects or some light work and see if they're a good fit. If they're executing like everybody else, well then they're probably a good fit. If after a month they're still getting ready to work on it like they do in large companies, then they're probably not a good fit. So I think the only way you can know is if you actually put them on the team in some way, shape, or form, and board of advisors is a good one, then you'll know if they're a good one or not. Let's see. Here's one more question. Okay, so someone wants to email me about a couple of companies that they're working with, one that is poised to grow, and yeah, I'll be glad to work with you guys about that. So by all means, email me any companies or questions you have, and we'll talk about what we can do to help them grow. If we need to help fill out teams or help raise additional funding, there's lots of things we can do to help people grow their business. So by all means, let's do that. If there are any other questions, go ahead and type them in now. Like I said before, if you want to dialogue about your specific situation, just email me. We'll set up a time to get on the phone, and we'll talk about your deal and what we can do to help you grow with what you're doing. And also, if you have any questions that we didn't quite get to, we'll do that. And so I will email you guys the slides after we sign off here in a minute, and I'll give you my email address. But essentially it's director@txenetworks.com. But let me shoot you an email here in a moment, and you'll have my email address, and you can just email me back based on that. If there are no more questions, we're coming up to our hour here, another minute or two, and we will send you the slides here in just a few minutes. And as I said before, we've also recorded this, and we'll post that on a link and send that as well. All right. Well, thank you guys. You've asked some really good questions today. Appreciate your spending time, and look forward to working with you. This is the first week of 4 weeks, so we'll meet next Friday, same time at 2 o'clock. Go through this session just like we did before. And as always, we'll send you the links to the webinar and to the slides as we do this. So with that, we'll go ahead and sign off. Thanks so much. You guys have a great weekend, and we'll go from there. Bye-bye.